What's up everybody? Welcome back to the channel. My name is Shawn King, and today we're going to be discussing the truth about the cash value in your life insurance policy and what most people get completely wrong. All right guys, let's get real for a second. If you think the cash value in a whole life policy is just a savings account sitting there for you, you're missing the whole point. And you're leaving a ton of opportunity on the table. Today, we're going to dive deep into what cash value actually is, why it matters, and how understanding it can completely shift the way that you view infinite banking and your financial life as a whole. If you're new to the channel, welcome. If you've been hanging around here for a while, then you should know we talk a lot about using properly structured whole life insurance to become your own banker. But today, this video is foundational for understanding what's really going on. Today, we're talking about cash value, which I believe is one of the most misunderstood concepts in all of finance. So before we jump into what cash value is, how about we take a second and discuss what cash value isn't? Let's start with clearing up the biggest myth out there. Cash value is not just a savings account at the insurance company. It's not an investment portfolio that grows if the stock market grows, and it's definitely not some kind of magical money market fund sitting off on the side waiting for you to access it. If you thought it was one of those three things, don't worry, you're definitely not alone on that one, trust me. But now you might be asking yourself, all right, well, if cash value isn't any of those three things, then what is it, Shawn? Cash value is the net present value of a future guaranteed payment. All right, think we could wrap it up? Kidding, but seriously, that's not very helpful, right? Especially if you don't speak insurance talk. So let's deconstruct that a little bit and really give you a better understanding. Your cash value equals what your current value or amount of money the insurance company would happily give you today to essentially walk away and say, we're good, close my policy out. See, the insurance company is on the hook contractually to pay that death benefit one day. That obligation is real, it's guaranteed, and it's unbreakable. And because it's so certain, it has real value today, not just when you pass away. Now, of course, if you die, the insurance company has guaranteed to pay your beneficiary out that lump sum of money. But if you decide, hey, I just want to surrender the policy and I want to walk away with that cash value, they would be more than happy to give you whatever amount that has grown to versus paying you out that massive lump sum that they're one day contractually obligated to pay. If you decide to do that, understand that you would be taxed though on any gains within the policy outside of the amount that you've originally put in. So there's a ton of different ways that we can explain this, but one thing that I often like to say is future guarantees create present value. So let's make this really simple, guys. I'm going to give you an example to follow along with here. Imagine you're looking at a $60,000 home renovation. You want it. You know you'd love it. Maybe you're putting in a pool or something. Not a big pool, not for $60,000, but a pool nonetheless. But that's a big price tag, right? You're thinking, probably not the most responsible thing for me to be doing right this moment. But consider this. What if you found out tomorrow you're inheriting $250,000 from an uncle? And that $250K, it's guaranteed to hit your account in 2 months. Would you think differently about pulling the trigger on that renovation today? Absolutely you would. Because when you have certainty about future money, it changes how you make decisions with your current money, does it not? Well, I guess you couldn't answer that unless you had guaranteed money in the future. Luckily, some of you do, but some of you don't. So you'll just have to use your imagination or hop on my calendar so we can fix that, okay? Anyways, cash value works the exact same way. You have a guaranteed death benefit, and that death benefit certainty gives the cash value real meaning today, even though the full payout doesn't come until later on. So at some point, you might have asked yourself, how do insurance companies actually do the math? Like, how do they figure out exactly how much cash value you have each year? Whew! Boy, you're going to want to avoid that mathematical equation like the plague, my friend. That's where actuarial science comes in. What are actuaries, you ask? Good question. No offense, but they're basically like super nerds who are really amazing with math and statistics, and they calculate the risk of when you're likely to pass away based on millions of data points. But they know two things. You will eventually die, for certain, and they have to pay out that claim no matter what. So they spread that risk across a ton of people, price it correctly, and most importantly, they account for the passage of time. So if you think because you have a page with some numbers on it and you have a calculator and you're trying to figure out what kind of mathematical equation they're doing, you're wrong. You'll never figure it out because you don't have basically any of the necessary information. You just see the final results on that page. So here's a quick way to think about it. If you live to 121, which is the technical maturity age of most policies in the US today, and you're still alive, the insurance company just hands you over your death benefit while you're still breathing. I don't know if they're like giving you, I'd be like, hey, can you bring me a big check? And that's why if you ever look at an illustration, the cash value equals the death benefit when you reach age 21. You beat the game. There are no more mathematical equations. Take your big old lump sum of money and go the hell home. Hopefully that makes sense, but maybe you didn't think that example clarified things enough for you. So let's try what I call the equity analogy. I think this is a bit more practical. Understand that buying a whole life policy is not like putting money into a piggy bank. It's much more like building equity the way that we would with a house. When you take out a mortgage, you don't own the full house immediately, right? You build up equity in your home over time through payments. Same thing here. When you first start a whole life policy, you've committed to future premium payments. You don't own 100% of the death benefit yet. Now, it's true that if you pass away, 100% of that death benefit is owed to your beneficiaries, but as far as that liquid cash access goes, you don't start anywhere near 100% access just like you wouldn't in a home. You're building equity in a home just like you're building equity in a policy. We just call it cash value. And every time you pay premium and time passes, more and more equity or cash value is built up. And if you were wondering, yes, time alone grows your cash value. Every day you live, your cash value ticks higher and higher, guaranteed, because you're getting closer to maturity. This is actually something the company One America shows to their clients specifically on a monthly basis. So I want to give you guys another quick example using a different scenario just to really drive the point home, you know? I'll call this the phone example. And this is going to highlight the time preference of money. Imagine your phone is a promise that a year from now, you'll get $10,000. If you tried to sell that phone, AKA the promise, to me today, do you think I would pay you $10,000 for it? Of course not. I'd pay you less because I'd have to wait to cash in that phone and get my $10,000. But as the year goes on and on, you get closer to that payout date, that phone becomes worth more and more. That $10,000 is coming. That's exactly how your cash value grows, even if you don't touch it. The closer you get to maturity, the more valuable it is today. Time plus premiums equals cash value growth, always and forever. Now I want to take a second and address some common misunderstandings and why Dave Ramsey gets this so freaking wrong. So a classic misunderstanding that you'll hear out there, especially from guys like Dave, is when you die, the greedy insurance company keeps your cash value. You only get the death benefit. He's literally said that exact thing if I didn't already insert a clip.
So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
All right.
Which makes it absolutely horrendous.
Dave, you're wrong. You're completely freaking wrong, dude. Think about it like this. If you're selling your house before it's paid off, you don't get the full value of the home and your mortgage money back. You get the net equity built up. Same idea here. When you die, the cash value isn't taken from you. It's already baked into the death benefit that your family gets. So to wrap up this video, here's why this all matters. When you're practicing infinite banking, your cash value gives you 2 superpowers. Number 1, guaranteed uninterrupted growth every single day. Number 2, access to capital whenever you want without interrupting the growth. You can borrow against your cash value at any time, and it keeps earning as if you didn't touch it in the first place. There is literally no other vehicle out there that can do that for you. Oh, and I forgot to mention, the longer your policy stays in force, the bigger your financial engine grows. And that's why it's critical to start sooner rather than later. You can't get back time. I think we all know that. Every year you wait is another year of guaranteed growth lost forever. This thing doesn't look great in the beginning. It looks pretty damn good in the middle, and it looks freaking fantastic at the end, which means the earlier you start, the longer that last stage will be. So if you've ever been confused about what cash value really is, if you've thought of it like a savings account or an investment, or if you're worried about losing it when you pass away, now you know cash value is your growing equity in a guaranteed contractual future payout. It's a claim on real capital, and it's one of the most powerful assets you'll ever own if you understand it correctly. If you don't already own a properly structured dividend-paying whole life insurance policy built for infinite banking, but this video kind of got you jacked up and excited, and you want to learn more, head on down to the description section of this video and click the link to watch our full save and spend system overview. After that, book yourself a free call with me and let's sit down and chat about your personal situation. As always, guys, the information is free, but the knowledge is priceless. I'm Shawn King. Thanks for tuning in. I'll catch you next time.